In just 36 hours, more than $7 trillion disappeared. Not slowly, not over months, not with warnings. It vanished violently. Gold, silver, platinum. Assets that humanity trusted for thousands of years were suddenly treated like liabilities. And almost no one talked about it. No emergency press conferences. No flashing red banners on mainstream television. No serious discussion on what this actually means. Because if people truly understood what just happened, confidence would crack. And confidence is the only thing holding this system together. This was not just a crash, this was a message. Why this crash is different. Markets crash all the time. Stocks crash, crypto crashes, real estate crashes. But precious metals? They're not supposed to crash like this. Gold is supposed to be the endgame asset, the thing you run to when everything else burns. So when gold collapses alongside risk assets, you're not looking at a normal cycle. You're looking at system stress. Silver fell nearly 30%. Platinum collapsed over 27%. Gold erased trillions in market value. This wasn't retail panic. This wasn't people selling jewelry. This was institutional liquidation, and that distinction changes everything. The interest rate weapon. To understand this crash, you need to understand one thing. Interest rates are a weapon. For over a decade, money was essentially free. Zero interest rates, quantitative easing, unlimited liquidity. That environment inflated everything. Stocks, housing, crypto, even gold. But that era is over. When interest rates rise rapidly, they don't just slow the economy, they reprice reality. Suddenly cash pays again, treasury yields become attractive, the US dollar strengthens, and when the dollar rises, everything priced against it falls, including gold. Gold doesn't generate cash flow, it doesn't yield interest, it just sits there. So when rates spike aggressively, capital moves fast. Not emotionally, not ideologically, mathematically. Pause. And here's where things turn ugly. Because the system wasn't prepared for this speed. The leverage. Nobody talks about. Here's what most people don't realize. The precious metals market is not driven by physical metal, it's driven by paper promises. For every 1 ounce of physical gold that exists, there are dozens of paper claims. Futures contracts, options, ETFs, swaps, all layered on top of each other. When prices rise, this leverage looks harmless. But when prices fall, the entire structure becomes unstable. Margin calls start triggering. Positions are force closed. Funds sell not because they want to, but because they have to. This is not panic. This is mechanical liquidation, and mechanical selling has no bottom. Paper gold versus real gold. Let's make this very clear. When gold ETFs crash, it does not mean people stopped believing in gold. It means they stopped believing in the paper representation of gold. ETFs like GLD don't require full physical backing for every share. They rely on authorized participants, custodians, and settlement trust. In a stress event, paper gold behaves like any other financial asset. It gets sold. But here's the irony. While paper gold collapsed, physical gold premiums quietly rose. Coin shops ran low, delivery times increased, spreads widened. 2 markets, 2 realities. One collapsing on screens, one tightening in the real world. This divergence never lasts forever. Why this looks like 2008. If this feels familiar, it should. In 2008, the crisis didn't start with banks collapsing. It started with liquidity stress. Funds sold anything they could, not what they wanted. Gold crashed in 2008 too. Hard. Then something interesting happened. Once forced selling ended, gold didn't just recover, it exploded. Because after the dust settles, people remember why gold exists, not for growth, not for yield, but for survival. And here's the uncomfortable truth. We are once again in a system loaded with leverage, dependent on confidence, and allergic to sustained high interest rates. This crash isn't the end, it's a signal. What this means going forward. This event tells us 3 things. First, liquidity is leaving the system, fast. Second, institutions are under pressure even if they pretend otherwise. And third, volatility is not going away. We are entering a phase where assets don't fail slowly, they fail suddenly, sharp moves, violent repricing, short windows to react. This is not the environment for blind optimism, nor is it the environment for blind fear. It's the environment for awareness. Because history shows us one thing very clearly. The biggest wealth transfers don't happen during booms. They happen during confusion. And right now, confusion is everywhere. The silent unwinding has begun. What you're witnessing right now is not a crash caused by fear. It's a crash caused by structure. Markets today are not driven by human emotion alone. They are driven by algorithms, leverage models, and liquidity thresholds. When one threshold breaks, everything connected to it snaps. And precious metals were sitting right at the center of this pressure zone. This was not random selling. Let's destroy one myth immediately. This crash did not happen because investors suddenly lost faith in gold or silver. Large institutions don't panic like retail traders. They don't wake up and decide to sell everything. They respond to risk limits, and those limits were breached. The rate trap. No one escapes. For over a decade, the global system survived on cheap money. Zero rates, easy refinancing, unlimited leverage. That era is over. High interest rates don't just affect borrowers, they affect collateral values. When rates rise, bond prices fall. Equity multiples compress. Commodity leverage becomes expensive funds that once rolled debt easily now face real cash pressure. So what do they sell first? Not the worst assets. They sell the most liquid ones. Gold, silver, platinum. Assets that can be sold instantly to meet margin requirements. Liquidity is not confidence. This is the part most people misunderstand. Liquidity selling looks like loss of belief. It isn't. It's survival behavior. A fund doesn't sell gold because it hates gold. It sells gold because it needs dollars. Right now, dollars are scarce. Not because money doesn't exist, but because it's being pulled back into the safest corners of the system. The dollar shortage effect. Every global crisis creates the same paradox. Everyone needs dollars at the same time. Corporations, banks, governments, funds. The dollar strengthens not because the US economy is strong, but because the system is desperate. When this happens, risk assets fall, commodities fall, even safe havens fall. Temporarily, gold doesn't crash because it failed. Gold crashes because cash becomes king. Paper markets. Snap first. Let's talk about the real damage. The collapse you saw was overwhelmingly in paper markets, futures contracts, derivatives, synthetic exposure. These markets move in milliseconds. They don't wait for logic, they follow rules written years ago for environments that no longer exist. Once volatility spikes, margin requirements increase. When margin increases, forced selling begins. This creates a loop. Sell to price drops to margin rises to sell more. That's how crashes accelerate. Why physical metal tells a different story. Meanwhile, something else was happening quietly. Physical markets didn't collapse, they tightened. Dealers didn't slash prices aggressively, they widened spreads. Inventories didn't flood the market, they slowed deliveries. This is crucial, because when paper and physical diverge, one of them is lying. And history shows it's usually paper. This is a stress test. Think of this crash as a stress test. It exposed how leveraged the system still is, how dependent markets are on liquidity, how fragile confidence becomes under pressure. This was not the final move, it was a warning shot, a preview of what happens when the system loses balance. Why central banks are watching closely. Central banks are not reacting publicly, but they are watching. Because precious metals don't crash in isolation. They crash when financial plumbing tightens, funding markets strain, counterparty risk rises. Gold is not just an asset, it's a signal, and right now that signal is flashing yellow. The myth of this time is different. Every generation believes it has escaped history. It never has. Every highly leveraged system eventually tests its own limits. The only question is timing. This crash tells us that timing is accelerating. Events are no longer spaced years apart, they're spaced months apart, sometimes weeks. Why retail always misreads these moments. Retail investors focus on price. Institutions focus on structure. Price falling doesn't always mean risk increasing. Sometimes it means stress is being released. The danger is not the crash itself. The danger is what comes after. Aftershocks are where damage happens. The first crash grabs attention. The aftershocks destroy balance sheets. This is when credit tightens. Lending slows. Defaults rise quietly. Markets may stabilize temporarily. But the underlying pressure remains. When crashes are loud, they're obvious. When they're quiet, they're dangerous. This one was quiet. No emergency meetings, no dramatic headlines, no panic speeches, just numbers moving and leverage unwinding. That's how modern crises begin. The largest crash in decades was not an accident. It was the system adjusting to reality. Higher rates, lower liquidity, and consequences that can no longer be delayed. This is not the end of the story, it's the opening chapter, and the people who understand what just happened will not panic, they will prepare.